Start. There we go. Okay, so sorry about that. I did a previous take and I didn't really like it, so we're gonna resume the stream. My apologies. So we're gonna play with 10 different robots, 100k, 30-year time length, 1 difficulty. I'm gonna go for 2 difficulty. That way we have tax implications, and I'm hoping that I'm able to beat my last record. Last time I played my Bond only series. So right here is my last fixed income only series that I did. Where basically I played the game and I tried to grow my wealth just by doing fixed income only. And I did some convertible bonds and I also did a few bond funds. But I discovered there are a few different strategies that I could play around with when it came to this game. And which I think is very, very, very interesting because when it comes to it, I actually discovered like a few potential ideas because a while back I talked to the creator of the game who made this, and I asked, hey, is there a way you can make shorten bonds a thing? And he's like, I don't know if that's going to be a thing, but what you can do is you can short bond funds. So I feel like that would be potentially a pretty cool thing to play around with in this series, is trying out different strategies that I didn't try last time to try and grow my wealth. So last time I felt like I had about, so episode 3, where was I was making millions of dollars. I started off with $100,000, and then, where was I? This was about 3 months ago, in May. So I've learned quite a bit about May, since May. We ended the game. So this is my last season. Okay, so I ended up with a net worth of $19 million. So that's going to be our main objective in this series, is try to beat $19 million assets under management. So I feel like that is doable. And it's going to be a little bit of a challenge though, because we have to include tax. But I feel like I can get there. So last time I started off with the series is I went through a bit of the theory. But before I go into the theory and everything, I should just say that like this video shouldn't be retaken as financial advice because like this is my personal investment approach. It might not work for you, and you may actually lose money when you invest, etc., etc. But today, what we're gonna do is we're gonna do bond ladder. So our main strategy will be bond ladder, which a quick summary from Investopedia is basically bond ladder's investment strategy that involves buying different bonds at different maturity dates. And so I usually like to give a bit of a terminology for bond ladder in this game as buying just short-term bonds just a few years out. Just buying like a bunch of short-term bonds. For example, whenever I think rates are very, very low and I think they're going to go higher in the next 2 to 3 years in this game, I'll generally buy a 2 or 3 year out bond, receive a bit of interest, receive a bit of coupons from that, and then basically I'll get my money back at maturity if there's no defaults, and then basically I'm able to invest at the higher rate. So like that's the reason why in this game I like to buy short-term bonds in this series, and I have plans on resuming that strategy like last time, where I'm just gonna buy up short-term bonds whenever I think rates are gonna go up. And I'm going to buy up long duration bonds whenever I think rates are going to go down. Because whenever rates go down, your bonds are worth more. And that's because you're buying a piece of fixed income and it's paying you 5% a year. But if interest rates go up to 6%, then your bond's worth a little bit less because other people are making it 1% more than you. So to account for that, your bond will have to go down a bit in price because everything like that. So we can go ahead and get started with the game. I'm on difficulty 2. So what we're going to do is I'm going to go ahead and get the zoom in, and then that way you guys can see the gameplay and learn a bit about bond ladder and everything else. And hopefully this game helps you guys make better investment choices to a certain extent. So I'm going to do streaming quotes and commodities. The commodities, in my opinion, is the more important type of thing in this game, because if you're buying bonds, like the main things I look at in this game is the long bond and the short bond. So generally in this game, there's a bit of a difference between the two of them. So like right now, this is a normal yield curve. So like whenever it comes to my bond analysis, so like this is what the yield curve is from Investopedia. It's like they talk about like a lot of this stuff. The yield curve is basically almost always upward sloping, where basically, so if I give it a little image, you can see right here that like basically your yield and your maturity. So like you basically have like your very, very short-term bond. Oh, my bad. I should have. You have your very, very short-term bonds right here and your very, very long-term bonds right here. So for example, over the long period of time, you expect to make more interest because default chances are potentially higher in the next 30 years. Inflation could be higher anywhere between the 30 years, everything else. So that's one of the reasons why longer term bonds pay a lot more. And also, you're also locking your money in for a longer period of time. So hence why they should be, hence why this is considered normal. This is considered a normal yield curve. And then there's also something called the inverted, which is the complete opposite, which is scary because it means basically right here you have your yield and your maturity. So you got very, very short-term bonds paying more than your longer-term bonds. So in that case, if they're like the inverted yield curve will be helpful if I have like if I'm doing like if I'm doing short bonds only basically. So we can see right. Sorry, but I got a call real quick. My bad. I handed up though because I have no concern about them. So we can go ahead and get started with the game. So right now I'm gonna start the speed to maybe an 88. I don't want it to be too fast and I don't want it to be too slow. So we can go ahead and get started with the game. We have to wait until February 16th in order to get approval from the thing. So we can see right here, congratulations, your criminal background check, and you did not reveal any serious criminal history, just 100 unpaid parking tickets in San Francisco, an outstanding bench warrant to for your arrest. If you ever set foot in that city again, nothing serious. Your brokerage account is painless, and so like that's who I'm doing it from. So right now I got my brokerage account. A brokerage account is basically a third party that you deposit money in and then you can invest. You can buy stocks, bonds. Sometimes you can do options, but sometimes you actually need to take a test in order to do options because options are very, very risky. But today in this series, we're only going to be doing bonds only and fixed income. So the two main things in this game that you can buy are bonds and fixed income. At least I'll be doing this series. So you can do right here. You can buy or sell bonds, for example. And right here we can buy a long-term bond. We can sell. We can buy a short-term bond, and we can buy corporate bonds. So the big difference between the corporate bonds and the government bonds are, well, the government bonds are owned by the government, and the government's actually known as almost risk-free to a certain extent. That's because the government can just increase taxes or just increase, they can increase taxes or just turn on the money printers in order to pay off their debts. So like they're almost seen as risk-free to a certain extent. But you're buying them out for a long period of time, so you could potentially lose money if rates rise. But in this series, I'm going to be putting more of a emphasis on corporate bonds because last series I put a lot of emphasis on government bonds and a bit of corporates. But then later on I switched my strategy to like more of a corporate strategy because corporate bonds, in my opinion, are better in this game because there's a lot more profit potential, but there's a higher chance of default. So those are the two bonds I'm going to be buying mainly in this series. And if you also want more bond exposure, I have objectives on going into the ETFs. So if you go here on the E, I'm just hitting E on the key. My bad, I should be zooming this in. So you can see ETFs. So like these are just funds that are managed by professionals, and they're very, very passively managed. So we can see right here we got 3 different funds we're allowed to buy in this series. We're allowed to buy the Prudent Government Securities, which is basically long-term and short-term government bonds, but it's an ETF. And then we got Blue Chip Fixed Income, investment grade corporate bonds, and then we got high income junk bonds we're allowed to buy in this game. So if I want to take a bit of extra risk for potential extra reward, I'll be buying up the high income bond fund in this series, but mainly I'll be buying the two. Mainly the blue chip fixed income. So I think that'll be a cool thing to get into. And also last time, I was talking to the creator previously. I think I've already said this in my previous take, but basically my last time that I was in the series, I knew that potentially the value of bonds were gonna fall because sometimes like interest rates were so low that I thought the probability of rates going up were very, very high in the long term. So I discovered a great way of playing the game is just to short the government bonds. So if you look over here and then look at like the chart of the government bond, well, we don't have a lot of historical data, sadly, but this bond actually does, this ETF, it gets hurt whenever interest rates go up. And so potentially, if I have a few $100,000 under my belt, I can do a short sale. So I can basically bet against the price of that ETF. And if I think it's going to fall, I can short sell that. And then we could potentially squeeze out a few $1,000 of profit potentially in this series. And that would potentially mean the difference between me retiring with 19 million and me retiring with more than that. So that's why in this series I have objectives on by shorting the government bonds and shorting bond funds whenever I think rates are going to go up. So we can go and get started with the game. Right now I think bond yields are at a decent rate right now, where like they're not too high and not too low right now. They're at 6% for the long, 5% for the short. And we can see right here that currently interest rates are neutral. So neutral basically means that the Federal Reserve hasn't really decided on what they want to do with their policy. So whenever it's easing, I like to buy very, very long duration bonds because whenever they're easing, it means that they're going to lower interest rates because maybe the economy is going through a depression or a recession and they want to stimulate economic growth. And so that's great. Or if it's tightening, and the reason why they would be tightening is because of inflation. Because inflation is a big, big deal. And the best way to combat it is just try to control spending. And one of the better ways of doing that is by controlling interest rates. It also, it kind of motivates people to save more money because whenever rates are going up, generally you're making more money off your savings account, etc. So right now, I'm not too sure what to do investment-wise. So we're just going to wait a bit. Hopefully interest rates do not go down. We can see right now that one of my best friends in this game is called the short bond. So I'm going to be watching the short bond like a hawk because I believe that is what the government controls in this game. And so whenever I see the government bond, the short government bond take a giant dive up or a giant dive down, it's going to basically mean, it's basically going to change over the long term, the long bond and the prime rate. So generally over the long period of time, you're going to see the prime rates will go up or down, depends on how the economy's doing. And so I usually like to look at the short bond as a potential indicator on what bond yields are going to be in the future. So if I see a giant uptick, I'm going to be a little bit extra. I'm basically going to be buying up some bonds whenever there's a big giant uptick. But in this game, I usually like to do the 8% rule. So there's this rule that I like to do in this game called the... So there's this rule I like to do whenever it comes to my bonds. It's called the Rule of 72. It basically tells you how long it takes for something to double in value. So what you just simply do is you can just do the percent return divided by 72. So for example, a 10% return divided by 7. So it takes 7 years to double, 7.2 years to double your investment. Where's the divide? I'm pretty sure there's... Yeah, here's how you calculate it. You take the number 72 and divide it by the investment's projected annual return. So, like, basically, it'll just tell us how many times the thing takes to double. So when it comes to that, 72 divided by 10, we got 7.2 years in order for our money to double. And so, like, a great idea would be if I can get 8% return. It would take me 9 years to double that money. So like that's my main objective when it comes to this game. Is my rule for this game almost all the time is try to aim for investments that get me at least an 8% return. And if I get less than that, I'm a little bit bummed out. So right now, bonds are not paying 8%, so I'm not going to be participating very much. So in order for me not to really participate much, but I still want to participate in the gains of it, I'm going to do recall database, and I'm going to go ahead and buy up a short-term bond. So we can see different types of bonds on our database that popped up. And yeah, so you can see right here, we can buy... I always like to do Notepad in this series just to discuss strategies and to have a good idea of where my portfolio is in the year in the game. So I'm gonna put my Notepad over here. So it is currently 2022. I always like to keep in mind what year it is whenever I'm playing this game because it's very, very helpful for fixed income. You can see right now that we have our bonds. So we have different types of bonds that we can buy right now. We have AAA, which is known as your investment grade, and then all the way down is BBB. So you can see right, yeah. So you got BBBs, which are still considered investment grade. So if investment grade, it's a very, very common term that I throw around a lot. A lot of these terms I throw around a lot. So we got investment grade. What the definition of it is? Investment grade, and then it signifies that a municipality or a corporate debt presents a relatively low risk of default. So default is my biggest nightmare whenever it comes to my bond portfolio because it means the company cannot afford their debts. So they declare bankruptcy, and for a creditor, bankruptcy is a nightmare because it means you lose your money or your potential not to get money back. So you can see right here, if I got my little highlighter out, you can see basically, you can see that use different designations, upper. So you can see AAA to BBB are usually considered investment grade. So we got there. Credit range for bonds below BBB, etc. are considered low credit quality and are considered junk. So when it comes to my series, I'm going to be trying to stick to a AAA to BBB guideline. And if I'm going to be buying junk bonds, I'm going to buy them for the speculation and for potential upgrades. So it doesn't mean that BBB bonds are complete trash. Like they could be completely they could be decent investments if you think they're going to get an upgrade because maybe they're having more revenue or their balance sheet's a lot better, etc. So they may potentially get an upgrade and then they'll be considered investment grade. So I'm basically going to be buying BB bonds every now and then, but we're going to be mainly trying to stick to investment grade bonds in this series. So now we can see our bonds that we can buy, and now it's 2022, and right now I think rates are at a decent level. So I'm thinking it might be a good idea just for me to go ahead and buy up maybe a short-term duration bond that pays a decent coupon. That way I'm able to lock in some gains while we wait for A, rates to rise, or B, rates to fall. If rates fall, I'm going to be a little bit bummed out because I bought a shorter term bond. But at the same time, it's better to try to lock in money right now at a decent rate. And if rates go up, I'll lock in quite a bit at 8%, etc. So you can see a 2027 bond, and if you do a bit of math, that's 5 years out, so that's a bit of a long duration, 3 years. I may buy up a little bit of this, like maybe $10,000, but I want to put most of my money in like 1 or 2 year bonds. So you can see right here, 2026. So that's about 4 years out. 2026, 2024. Here you go. This is what I was kind of looking for. But you can see right here that like oh, my bad. Trader Joe's right now, you can see that the coupon of the bond is 4.75%, and that's when it's at par. So at par value of a bond is almost always $100. So that's par value. And so anything below $100 is considered a discount bond, and anything above $100 is considered a premium. And so because this bond is trading at $115 per bond, you can see that the yield to maturity is 0. So I'm looking for basically bonds that pay more than basically bonds that have a higher yield to maturity than coupon, at least in the short term. So like this bond, it pays like a decent coupon, and then your higher coupon bonds like this one right here, Qantas Airways, pays 8%. So this bond will be less volatile in the long term because it's got a higher coupon. So if you're playing around with this series, your lower coupon bonds are by far the most volatile, and also the longer the term, the more volatile. So this low coupon bond, it could be highly volatile in price. So if rates rise just a little bit, that bond's value is going to get hurt a lot, while a higher coupon bond will actually do alright. So this one right here is paying us 6%. That's pretty decent. 2037. We're looking for like a somewhat liquid. So a 3-year bond will be pretty decent, but at the same time, it's almost not that liquid in my opinion. But it is a discount bond, which is pretty nice. So let's go ahead and buy up some of this. I'm going to buy probably $25,000 worth of this bond. We're just going to do a bit of bond layering for right now. So you can see like this important we have to do a bit of math in order to calculate how much bonds we're going to buy from this dealer. You can see right now it's AA. Yield, the current yield is almost 6%, which is pretty great. Accrued interest is $8 per bond. And that's just basically the accrued interest is basically the price that we have to pay to the previous bondholder, because he's holding it for, well, every 6 months you get paid by a bond. So let's just say that this is like 5 months of him holding it, or a month of him holding the bond, and so we have to pay him that $8. I think it gets reimbursed, not too sure. But the majority date is 2025. Call provisions are at 102. That's very important to keep in mind. And also the call date, like there's a specific call date. It's callable now at 102. So if it gets called right now, it's not really the end of the world because we're buying this thing for a discount. But if you buy your bond for a huge premium, and then the call price is like 105, it could potentially get called for less, and you could lose a lot of money potentially. So keep that in mind. But now we're gonna buy $25,000 worth of this bond because I think it's pretty decent. It's for 3 years out. And we can see right now that the price is $92.44. So I usually like to think of that as in hundreds of dollars. So it'll be $924. We can buy 27 of these bonds. 27, enter. And just to make sure the math is correct, we can see right here we are buying $27,000 face value bonds, 5.5%. General Electric at a price of $92 each, plus a $50 commission, for a total purchase price of $25,000 and $8.80, plus accrued interest of $231. I'm down for that. Let's go ahead and get into that deal. So we went ahead and bought our first bond. We can see right now that we have our bond, General Electric. So this bond matures in 2025, so that's 3 years out. So I'm gonna look for a 2-year bond that matures in 2 years. So that will be 2024, and maybe if there's a bunch of 2024 bonds, that'd be great. But also, I want to keep a lot of cash in this series because cash is important. Because the thing about that bond is it matures by 2025. Of course, I can sell it anytime, but potentially I might have to sell it for a loss if interest rates go up in the short term. So that is why I like to keep a lot of cash. So I'm thinking about doing 50-50, keeping 50% cash, 50% bonds that are short term. So right now we're going to go ahead and find a very short term bond. 2025, relatively short term, but we're looking for a lot shorter than that. 2029, that's too long out. 2026, no. 2027. 2025. I used to be able to scan through this. I'm also kind of tired, so it's a little bit harder for me to scan through all this data. 2028, 2030, 2028, 2042, 2028. Gosh, I'm having trouble finding them. Oh, can't actually go through it really quickly. 2026, that's relatively far out, 4 years, but that's not too far out. 2025. Oh, did I just see a 2023? 2033, that's my bad. Yeah, so I don't want to bore out the content, so we're not going to look around for a 2024 bond. I don't want to really bore out I don't want to bore out the video and make it too long. So we're just going to keep that bond for 2025. And if rates go up, I'm going to be locking into some long duration bonds. But right now, we're just going to keep that bond. So we can see right now we have almost worth 25,000. And we can see our cash flow. So the reason why I bought that bond is we're going to make about $1,000 off of it. So the big question you might be asking is, why did you buy the bond? Well, you can see right here of interest rates. Our broker is paying us 0.73% for every dollar we have in our account, basically. So that's pretty bad. So if I can get at least a 5 or 6% return for the next few years, I can actually make some decent returns. So that's why I like to buy short-term bonds in this game instead of keeping cash. But I do like to keep a lot of cash just for opportunities. Like, that's what cash is really meant for, really. You shouldn't be using it as cash as an investment because all over the long term, it's going to deteriorate in value. So hence why I'm a big fan of buying shorter term bonds in the series. So we're just going to keep a lot of cash right now. It's going to hinder our growth over the long term, but of course I'm going to be making some investments. So I'm going to be keeping my eye on this. And you can see right now that interest rates are slightly on the downward trend. So do I make the trade on betting that interest rates are going to fall? Maybe. Let's go ahead and let's go ahead and take a bit of a risk because I'm seeing a bit of a downward trend in interest rates and potentially we could make some bank off of it. And that will really increase the progress of our portfolio. So I could buy a 2041 bond. That'll pay us 6%. I'm looking for some Bs though. Like the Bs are going to pay us a decent amount. So this one right here, Dow Chemicals, paying us about 10% coupons. That's pretty good. So if you do the rule of 72, we'll double our money every 7 years. So that's pretty reasonable. So I'm going to go ahead and just put all my money into the Dow Chemical bonds because I see interest rates are in a downward trend, so I want to take advantage of that opportunity. I'm doing tactical asset allocation right now where I'm just making an opportunity investment where I'm going to keep this bond for not a long time. So interest rates are falling. That's good. They went up a little bit. Okay, they're at 5.2%, 5.9, 5.19. Interest rates look like they're kind of going up. The company, they reported a profit. So right now our bond portfolio ain't doing so hot. It's doing alright. I'm betting over the long term that interest rates are going to fall. We're going to probably underperform though if interest rates do go up. So I feel like it might be a good idea just to get out of the bond, especially if rates continue to fall. If they rise though, I'm okay with putting my cash flow because right now we're making about $7,000 a year, which is pretty decent. And then after taxes, that should be about 5.7 thousand. So that's pretty great. So my main objective is that interest rates fall. That way my long duration bond does well. But if we look over here, for example, of course the values are way more different. But we can see right now the interest rates are kind of going up again, which has me a little bit worried. Well, we made a decent profit off this bond. We could theoretically sell it right now. But I'm looking for a bit of a bigger profit if interest rates continue to fall. But if they continue to rise, that's going to make the... Yeah. So I'm gonna go ahead and cover my. I'm gonna go ahead and take my win on this bond because I feel like I made a slight mistake by buying the bond because I'm thinking that interest rates are quite likely to go up. But I'm also in the mid zone where I don't know whether or not interest rates are gonna go up or down. So it's probably better just to stay in cash. So we took about $1,000 gain. We're at 78K right now. We're doing all right. Let's go ahead and find a very liquid bond. 2035, 2024. This is a pretty decent one. So we look over here. This is what I like to always consider whenever I buy my bonds. Is right here. It's going to pay us about 9%, and we're paying 103 for it. So I always like to do the math of 9 minus 3 because we're paying $3 over the par value. So we're going to be making about a 6% return off this bond for the next 2 years. So that's pretty decent. 2026. What are we looking for? We're looking for like a very short-term bond for like, but I'm not finding any 2024s. So I think a 2026 bond wouldn't be a bad idea. But at the same time, like I said, cash is probably better. I'm waiting for rates to rise. Once rates start hitting the 8% on the long bond, I'm gonna be eating up bonds like crazy. And then you might be asking, why would you lock in your bonds at 8% if you think rates are going to go higher? Well, I don't want to be greedy because if I don't know what interest rates are going to be doing. Okay, I think this is a little bit too slow pace for my liking. I'm going to do a 95. Hopefully this is not too fast. Okay, interest rates are starting to fall. So, like, they're kind of flattening out right now. Like, the last year, they've been flat. What I like as a bond guy in this game is I like volatile interest rates, where interest rates hit very high levels and they hit very low levels. But, like, that's not the case, at least for now. Hopefully interest rates go up, but they've been kind of flat for the last 2 years. For the last while, I mean, not the last 2 years. We just started in 2022. September. Profits in stocks market into tailspin. So if you look over here, people are taking their profits, so that made stocks fall quite a bit. That is also known as like a leading indicator. So a leading indicator might mean that like a stock market recession might happen and economic progress might slow down. Because if you look over here at GDP is a very important indicator for potential short rates, because GDP means how well the economy is performing. So if the economy is performing really well, then it's very good. Typically, a 2% GDP is normal, at least in my opinion, 2 to 3% for mature countries. So in this case, GDP is booming. So that means that likely inflation is out of control. And so likely over the long term, interest rates are going to go up. So if GDP stays strong, interest rates are likely to go up over the long period. So right now, it's a decent idea right now to buy bonds right now. So we're making about 7%, and our bond is 2025. So I'm pretty glad I only locked in $25,000 of that bond at 2025, because right now we can see that it's 2022, and we lost a bit of money on it right now. And if rates continue to climb, now they're climbing up aggressively, and with the interest rates climbing up aggressively, you can see right here that the GDP growth has actually went down quite a bit. That could be because interest rates are going down. Because interest rates are going up. The central bank is trying to slow down the economy, because a too fast economy means hyperinflation. It means that basically the cost of goods just keep going up and up and up very fast. 2% inflation is usually normal. So right now we're in a bit of an inverted yield curve environment, where basically you can see right now that the short bond is slightly above the long bond. And so now it's time to gobble up investments. You can see right here that we're making about 9% of the long and 9% on the short. So this is when I start gobbling up in my investments. Because if you look over here, A bonds are paying us now 10%. And the triple Bs are paying us about 12%. So if I do a bit of the rule of 72, divided by 12.65, we made 5 years to double our money. So like that's pretty decent. This is not including fees too. Like the yield would not be 6%. But like for example, if you look at like as a big example, where's a low coupon bond? This is moderate coupon, decently low coupon. Oh, right here, a 4. You can see how volatile look at like that. Like the yield is 4.25, but the yield to maturity is 11. So like generally your shorter term coupon bonds are going to be hurt a lot. So right now I'm going to buy up a long duration bond right here. You can see that like Baker Hughes right now is paying us about 12%, and it's for 2040. So if we do 2041 subtract by 20, about 19 years of 12% payments to me. That sounds pretty great. So we're gonna go ahead and put like it's hard to decide how much I'm gonna allocate. I'll put 25k. I'll probably put 50k into this bond because it's paying a very good coupon. 50k budget. Buy BHI bonds. You can see right now it's triple B. Current yield is 12.14%. And then we can see that like it's callable at 105 beginning of 2032. So it's callable in 10 years at 105. Would it be buying it for $755? So we could buy 66 of these bonds. And it's going to cost us a little bit less than $50,000. Cool. So now we have a General Electric bond and a Baker Hughes bond. The Baker Hughes bond is going to be very volatile to interest rate increases, but we're making a good return off of it. We're making about a 12% return. So now we can see our net allowance. We're making about so we can see right now 7.5k we're making a year. Minus all the tax, we can get 5.5k, and then plus our current cash balance of 27,000, we're expected to make 33k by the end of the year. So that 33k can be used towards buying up more and more bonds at potentially higher interest rates. But right now, I don't really care whether or not interest rates go up or down. Ideally, I want them to go up. But if they go down, I'm not going to be crying like a little baby because I just bought 50k worth of bonds. We're going to use that 5k of after-tax cash flow towards specifically buying up more bonds. And then we're going to rinse and repeat the strategy until I hit a decent amount. And then I may modify around the strategy a bit. So right now the GDP is slowed down a lot. So right now it's probably a great idea to make up some investments because potentially interest rates may be going down in the long term. So I think if they're going to be calming down on the whole, nope, they did not. They're not going to calm down on raising up rates because you can see right now as rates rise, banks tighten lines of credit for corporations. So they're going to be more picky with who they lend out to. So that means that basically the supply of credit is down, but the demand stays the same, supply and demand. So in that case, interest rates should be going up over the short term. And like you can see right here, my chart, we've been staying kind of flat mostly, but we've been going on a bit of a downward trend. That is because interest rates have been going up. And if you look at our bond portfolio, ouch! Look how badly we got hurt because of that Baker Hughes bond. We'll be making about 12% a year, but that's just a short-term loss. This is a unrealized gain or loss. So this $5,000 we see right here in L, it could potentially come back and we can make our money back. And plus, why would I sell at a negative $5,000 loss in this case when I bought the bond for $75 and it's going to mature at $100? So eventually over the next over the next 19 years, we're going to be getting a $25 per bond profit. So that's still pretty decent. And we still have a decent amount of cash, and I'm going to be gobbling up some bonds. So you can see that interest rates are quite high right now. And like if you want to read the analyst reports, where are they? Analysts. Should say on the very, very bottom. Economic conditions might support sustained steady growth are currently somewhat mixed with moderate energy prices, high interest rates, and very low tax rates. So right now, interest rates are considered high. So like this is what I like to consider making my investments into bonds. So we're going to continue making investments into very, very long duration bonds. I'm going to say it might be a good idea to make another investment in a bond in a little bit. GDP is starting to slow down a lot. So I'm going to go ahead and lock in my money for the long term. I'm going to lock in all my money in a triple B. So I'm looking for a very, very long duration. Right here, Reader's Digest doesn't look bad. I'm looking for anything higher than 2041, but potentially there's not. And here's junk territory. So this coupon is 14%. And this one's 14.8. Okay, I'm going to go ahead and buy up some Reader's Digest bonds. And if you actually look at the actual company, they don't have a lot of liquidity, but their bonds do in a very, very long period of time. And like I like to somewhat replicate what my friend Raken does, and he does bond buying back strategies. So in this game I play Wall Street Raider almost all the time now. And a strategy is whenever rates are very, very high, you can use $800 million divided by 2 because it's $57 per bond. You can buy back that bond for cents on the dollar. So you can potentially, basically what you do is you can basically buy out this $800 million worth of debt for $400 million. You can buy this debt for cents on the dollar, and now increase your EPS and everything else. So like that's a bond buyback strategy. I can actually show you my. I'm gonna go ahead and show you the video. Just at least show you it. So what he does is he calls it the bond cancellation strategy. So what he does is he basically, his strategy consists of whenever interest rates are ridiculously high, you just simply buy back the bond for cents on the dollar, make a giant profit, and you don't have interest to pay, etc. So it's potentially a pretty good strategy. And it's by this guy, and he just determines a great way of starting off the game. And when you play Wall Street Rare, you can easily turn $1 billion into $100 billion. Pretty interesting. So I've been playing around with that strategy a lot when it comes to me playing Wall Street Rare. This series is mainly about, when it comes to this game, this series is mostly just about, it's just, we don't have as much control, basically. When you're buying bonds or company stock, you don't have as much control. Because if you actually have control over the company, you can tell the company how you want it to go around and how it management works and everything. So right now we have almost no cash, $149, and we have a ton of money in long-term corporate credit. So we have Reader's Digest and Baker Hughes, very, very long duration bonds, and in 2025 we have a bond. So hopefully by 2025 interest rates stay high. That way I'm able to put the $25K towards another high interest bond. Now we can see our cash flow. We're making $11,000 pre-tax. After tax is $7,000. So that's pretty decent. That $7K will be used towards buying up more bonds at potentially a higher interest rate. So I'm actually perfectly fine if rates continue to rise. Ideally, actually, I want rates to stay high for a long period of time. And sometimes that has happened in Wall Street Raider. Sometimes rates have stayed in the 20% range for, or at least somewhere in between the 15 to 20% range for a long period of time. And I made quite a bit of money doing that. Or I've lost a lot. I've went bankrupt in the 15 to 20% a lot because I do interest rate swaps. And it makes me have negative cash flow, and I almost always go bankrupt in that game. So right now, I'm a little bit bummed out because interest rates are high. but they're a lot volatile right now. Like, it just went from 13 to 15, 12. So I feel like right now the government is deciding that it's probably a decent idea. Okay, so we have a new event that popped up. Financial News Bulletin. Sun Life Financial Inc. has been insolvent and been taken over and recognized by government regulators. Its old stock has been canceled and new stock was sold to the public with the proceeds used to pay off part of the policy liabilities. Once the company's net worth had fallen to zero and its ability to make good on promised insurance coverage to policyholders became doubtful, the government insurance regulators were forced to intervene and replace the company's floundering management. So insolvency is basically when the company has more liabilities than assets. So assets are basically things that you own. So for example, a house might be considered an asset, or your clothes might be considered an asset, or a computer, etc. And things that you owe are like car bills, etc. So like you basically have more car bills than, or more car. Yep. I thought that would have brought down interest rates because a big oh yeah, it is. It's bringing down interest rates. So right now, you can see that like right here, it's been going up, and then you can see right now on the candlestick chart that interest rates are starting to fall for the short bond. So that tells me that right now it's a very, very good opportunity to lock in, and thankfully we have $2,000 in cash. We can buy about 2 bonds. So I'm gonna go ahead and do that. We want to lock in almost all of our cash at these very, very high rates. Oh, I could buy a junk bond. Let's go ahead and buy up a junk bond for some fun. Okay. So I'm going to go ahead and change around the database. And we're going to look for earnings up 3 years. And we're going to buy up a junk bond that just a company that has a reputation for increasing their management 3 years in a row. So then they should be able to get an upgrade. Earnings up 10%. So right now we can see that right now we can buy a Jack in the Box, Carl's Jr. Rest. So I'm going to speculate a little bit and buy up a junk bond. Do I buy up Oxford Health Plan? Going from double B to single B is usually concerning for me. American Online, that one's 15% coupon. Very, very low liquidity. Liquidity being cash and cash equivalents. And then I like to look at something called the current ratio. Whether or not the company can afford their debts. And their current ratio isn't very, very good. So you can see right now that they have quite a bit of liabilities. But they do have quite a lot of equity. This equity sign will be negative or 0 if they were insolvent. So they're actually quite solvent. And so I'm thinking over the long period, interest rates are going to fall. That will make their variable bank loan great. But at the same time, I don't know. Stock and subsidiary groups. What is their subsidiary? AOL. I want to look for like their list portfolio. They have Time Warner and Twitter stock. Most of their money is in Time Warner. How's Time Warner doing? Like, potentially if Time Warner goes up, that could potentially bring up the value of the stock. And potentially they could get an upgrade. Or if their revenue does very, very well, they could potentially get an upgrade. 13 times earnings. Very, very low dividend. A lot of debt for Time Warner, too. I'm going to probably pass up on buying up that bond. I usually like to do a lot of research whenever it comes to junk bonds. Carl's Jr. Let's just buy up some automobile company. $10 billion in cash. A big variable loan. A big... Yeah, it's like potentially like these are not so sound financially companies. I'm just going to go ahead and risk it and buy up a junk bond. We're just going to buy up a little bit though. We're going to buy up 3 junk bonds. So right now when it comes to our bond portfolio, we have a General Electric bond for 2025. We have a Baker Hughes bond. So that's the one big problem about buying the General Electric bond is right now we've lost a bit of money on it because it's for a reasonable period of time out and interest rates are much higher. But we have our Baker Hughes bond, which is making us a decent return. We got Reader's Digest, and we also got Cherry Automobile. Cherry Automobile is basically my high income bond that I bought. So I'm hoping that over the long period of time, interest rates continue to fall. Or in the very, very long term, they stay high and I continuously reinvest at a higher rate of interest. I'm okay with that. I'm okay with either or situations. Ideally, I want interest rates to stay high for quite a bit of time. But if they're going to fall, I want them to fall a lot. Okay, there's been a bit of a sharp upturn in stocks. So, and the economy is back booming. So potentially that might be a catalyst for interest rates going up. Right now they're tightening. So like this is potentially good because it means that interest rates are going to be going up over the long period of time. So that's great for us because if you look at our cash flow, we're making about $7,000 after tax, $1,000 for our cash, $8,000. So I'm hoping that over the next while, I'll be able to invest $8,000 into a very, very high coupon bond. And then we're going to continue making more and more money out of our money over the long period of time. Right now, I don't really care where interest rates go, though. Ideally, I want them to go up, though. That way I'm able to lock in at higher rates. They are going up. That's sad for our Baker Hughes bond because we lost a lot of money. But it's good because we're getting coupons. So right now I'm able to lock in at a much higher rate. So let's go ahead and do that. I'm going to go and get rid of the database search. Get rid of that. Damn. Okay, so I'm looking for some triple Bs. Right here, 2042. That's a pretty long out bond. Paying us about 15%. I'm going to buy Nikko Securities. Going to pay us about 14.79% interest. That's pretty great. So I'm going to buy up 4 of those. It's going to cost us about $2,000. Alright. And now we have about $95,000 in bonds. Most of our bonds are getting crushed, especially our Baker Hughes bond. But I'm okay with that because I'm able to reinvest my cash flow at a higher yield. So that's okay. And here's our income. We are making $7K after tax, $8K. So right now is where I like to play very, very aggressive with my bond purchases. Because right now I'm making a lot. But we don't have a lot of money under management. So it's a lot harder for us to make money on money. Because right now we're only making $8K a year. And we need at least $1,000 in order to buy a bond in this game. So it's going to take us a bit of time for us to do everything. And interest rates just took a giant nosedive. They went from around 15% to 12. So that's good. That's good for our bond portfolio because if you look at our bonds right now, you can see that our bonds are worth... Oh, they actually haven't done as well. But has our friend shared got an upgrade? They're still double B. They have $0 in lines of credit. So that sucks. 42 cents a share in expected earnings from the analyst. Okay, so they're probably not going to do as well as last year. So they potentially may not get an upgrade. But I'm thinking if rates do go down, then that'll be very, very good because this bank loan is variable. So whenever rates go down, generally it means that the variable rate means that you're paying a lot less interest. And whenever rates go up, you're paying more. Okay. Hopefully rates continue to fall. We continue to make more. I'm thinking about ending the stream in about maybe an hour and a half. That way I can go to bed and have a good night's sleep. I have a long day tomorrow. Interest rates are continuing to fall in a downward trend. And now they're starting to fall a lot. So usually whenever they hit the 10% mark is usually, if they fall below a 10% mark, in my opinion, there's a bit of a giant bond sell-off and then rates continue to tank. But sometimes they'll chill around the 10% mark, at least when I'm playing Wall Street Raider. So we'll continue and buy up another long-term duration bond because we have extra $2,000. 2030 for long duration, PACCAR. Worst case scenario, we just keep these bonds for cash flow. But best case, interest rates fall and we're able to sell these bonds for a capital gain. You might be asking, like, why do I want to sell them for a capital gain? Well, if you look at economic statistics in this game, you can actually see the tax rates. So with tax rates in this game, you can see ordinary income is 26% taxed, and capital gains are 18%. So ordinary income is basically in this game, it's dividends, salary, and your interest income. So our interest income is being taxed at 26%, whereas capital gains are 18%. So a lot of the times it actually makes sense to sell your bonds in this game than keep it. Especially if you think rates are going to fall. No, especially if you think rates are going to go up. You want to sell it, lock in your gains, and then potentially just buy up some short-term bonds. Secure those wins. So we look at my chart, I'm starting to do pretty well in a lower interest rate environment. You look, we just made bank. So now we made about $13,000, 14, 18. And you look at our bonds right now, we have a $4,000 gain, Reader's Digest, 300, and our low quality bond is up 300, and our Baker Hughes is down, because that's one of the first bonds I bought around 8%. And I bought a bunch around, so like this is like a pretty great idea. So if rates continue to go down, I'm happy. Ideally, I want them to go down though, because we could sell our bonds for a capital gain. But high interest rates for a while makes a lot of sense if I have a lot of AUM, assets under management. Interest rates continue to tank. That's good. $2024, so we should be getting our money sometime next year for our 2025 bond that we bought. Pretty great. $6.5. So look at the interest rates. They practically tanked. And so like what I like to do is I usually like to occasionally in this game I'll draw support and resistance lines in my head in this game. So if you do Screen Snipper, for example, you can see that like basically resistance was somewhat around there, and then there was some support around here, but then it kept falling, and then they're about to hit like a support line. So like it might be a good idea for me to sell out right now, because if you look over here before, they were around this level, but like now they're starting to hit the level that they were prior. So that has me a little bit worried potentially, because interest rates might continue to go up over the long term, or they may continue to fall. But because I saw a downward trend, I saw potentially over the long period. So they might flatten out, or they may continue to fall. And they're continuing to fall. They're easing. So like this puts extra points on me believing that interest rates are going to continue falling. So because they're going to continue falling, I'm going to keep my bonds. We're doing alright though. We made like a 30% return on our bond portfolio. That's potential capital gains. Here you go. Housing boom anticipated. Leading economists predict lower interest rates will help the housing and building materials industries, coupled with strong economic growth, and also expected for the next year. So that's good. So they're going to say that basically over the long period, that over the next year, they're expecting interest rates to stay low. So that'll be very, very good for our bond portfolio. And we have about 3K in cash. 30. Yeah. And our bonds are making us a lot of bank right now. So that's pretty great. So I didn't want to sell any of my investments at a very big loss. Banks more aggressive in lending, increasing loan limits. So that means basically they're increasing the supply of credit, because whenever interest rates fall down a lot, the government usually encourages banks to spend money by making the overnight rate very, very low. Okay, so right now I feel like it's a good opportunity for me to get out of bonds altogether. It may fall, interest rates may fall to 1% on the short, but right now I feel like it's a decent opportunity for me to take some profits. So Baker Hughes, we made $22,000. That's pretty exceptional. I'm going to probably keep these smaller bonds that we bought, but I'm just going to take the bigger gains. That way we have no pressure whether rates go up or down. So we're going to sell 66 of these bonds at a price of $111 a bond, $50 commission to sell, for a net sales price of $73,000, plus you receive $1,000 in interest. So right here we made a capital gain of $22,000, 500. Okay. So if I want to expect my anticipated tax bill in this game, well, capital gains taxes are 26%. So 22,596.27 was our capital gain, what we made from the profit from the sale, times 0.18. We're expected to pay about 4K in tax from that. So let's go ahead and double check on our math. So right here we got buying power, realized capital gains 22K, year to date tax, year to date income. So we owe about $6,000. That's it's probably $2,000 higher because we had income coming in for coupons and etc. It's alright though. We're gonna pay a bit of tax. It's okay. Okay, and then rates continue to fall. That's great. Baker Hughes made a profit. So right now I'm going to go ahead and sell my big bond. We're going to go ahead and sell our Reader's Digest bond. ROA. So we can see right here, it's, the ask is for 107. So it's for a pretty high price that we originally paid for. And we're going to sell 51 of these. And we're going to receive net proceeds of $54,000, plus you receive accrued interest of $700. That's pretty great. And then we can see right here that we made a $23,000 capital gain. It's pretty great. So we can see right now that we have about $129,000 just sitting in cash, and interest rates are at rock bottom levels. So sadly, with us selling the bonds, we're no longer making bank, but we're doing pretty well. Like if we look at our cash flow that we're making, projected adjusted cash flow is $23,000. Most of that's coming from the bond that's maturing by 2025. But our taxable income, projected net income. Yeah, so we're expected to make about $2,500 every year from our existing bond portfolio. So it might be it'll probably be smartest, honestly, just to sell all these bonds right now for a slight gain, and then just reinvest into like a short-term bond, maybe. But right now, I'm gonna go ahead and buy up a short-term bond. But of course, we have to pay our taxes. Like, how much taxes do we have to pay? We have about $11,000 in taxes. So what I like to do is I usually like to subtract it. So I have about $100,000 to spend. I'll keep the rest in cash. So recall data, but I like to see what year it is too. That's pretty helpful. 2024. There we go. So now we're looking for pretty liquid bonds. 2025. That might be potentially good. There potentially could be a profit made off of the Deutsche Bank bond. 2036. 2028. 2026. $2040, $2029. Okay, let's go about the Deutsche Bank, because I feel like that might be a great idea. Could there be potentially a good one? 2028, 2027. So that's about 3 years out. Pretty long. I think in rates in the next few years should be higher by then. So I'm looking for anything between 2025 to 2026. So right here, 2026 pays a 0 coupon, sadly, but that's because it's convertible and the price is $200. So like just because the bond's convertible, it means that it's at 206. So I could theoretically buy up a convertible bond right now for a little bit of extra entertainment. Like we could theoretically just buy up convertibles for a 0% premium and potentially get some stock market gains. 2025, 2028, 2026, 0 coupon though, sad. 2028, 2026, 0 coupon. Huh, that really sucks. I'm not making much of a return off those. I don't want to underperform and keep cash too, that sucks. So I'm going to go ahead and just buy up a bunch of the Deutsche Bank bond. Or buy up like 50k of it. It'll mature in about a year. It's going to pay us a decent return. And I'll just keep the rest in cash. So we can see right now, we're going to be paying 101 for the bond. Oh. 101, 101.3. So we're going to be buying about 49 of these. That comes to about $49,696. So right now we have $83,000 in cash, $83,000 in corporate bonds. So right now we're quite balanced on the risk-reward spectrum. And our Deutsche Bank bonds due 2025. And if you think about it, 2025 is about a year out. And we're making a decent return off of that. So I'm pretty happy. We should be able to make a decent profit off that bond. Like, not a lot. And interest rates continue to fall. So that's very, very good for our bond portfolio. So right now, if I had margin, I would short bond ETFs. Because you look over here at the research, this industrial growth rates, ETFs, fund investment strategy. I would theoretically short this bond fund, the government one. So if you look at the government one, their current price is at $67 a share. And if you look at the stock chart, you can see that this is when interest rates were kind of low. Like, they're kind of low because interest rates were really, really high. Oh, my bad. And then right now, interest rates with them being rock bottom lows right now, I'm thinking potentially this bond fund has little upside and a lot of potential downside. So right now, I would theoretically short this bond fund, but sadly, we do not have ability to short right now because I think we need at least $200,000. I think it's $300,000 to short. So sadly, we don't have the AUM to do that. So like that's part of the new strategy. Is honestly over the long term, short this bond fund, wait for rates to go back up, and then potentially we might make a giant capital gain because the fund will get really, really hurt. But right now, we don't know whether rates are going to go up or down, but it looks like they're going to go back down a lot more. Okay, so right now, rates are at rock bottom levels. I've seen them as low as 0.8 and 0.75% on Wall Street Radar, but they're almost as low as you can go. At 1.25% for the short bond and 4% for the long, that is almost as low as they can go, in my opinion. So right now I'm going to dump a bunch of my bonds. I'm going to sell the Nikko securities. I'm also going to sell the PACCAR. This is where I would like to short bonds, but at the same time I can't do them because I don't have margin. So at the moment we have a bunch of Deutsche Bank bonds due by 2025, and we have a bunch of General Electric bonds due by 2025. So we get a ton of liquidity by the next year. And then if rates continue to stay low, I may buy up another 1-year bond or another 2-year bond. Or it makes sense mostly right now to keep a lot of cash, just because I'm thinking the likelihood of rates going up are quite high. The thing is, though, I don't know how low rates are going to stay down here forever. They could stay down here for a while. They could stay down here for a short period of time. So that's why sometimes it actually makes sense to keep a bit of your bonds, but mostly almost all the time at these very, very low rates, I almost always sell them. So we're at Here's our cash. We have $87,000 in cash, $76,000 in corporate bonds. So we're doing all right. We're living. I would like to do interest rate swaps at these very, very low interest rates, but at the same time, this is not Wall Street Raider. You can't do swaps because those are considered more speculative and they're like derivatives. Okay, so now interest rates have went up quite a fair amount in the short term, and the fund that I usually like to track is the ETF. I think it's GovB. I always forget like the tickers for these funds. Yeah, I think it is GovB. Yeah, it's GBND, my bad. So you can see that their price has been fallen, so potentially this short might have paid off, because you can see that right now that the price of it is a bit of a downward trend. That's because interest rates are going to go up. So right now they're going up, and another tank in the bond price of the GBND. So like this is like my new way of doing strategy in this game. Is going to be whenever I get margin and whenever I'm able to short sell, I'll be shorting the government bonds whenever I think rates are going to go up. So sadly I wasn't able to take that opportunity to short, because we would have made some good money off of it. We would have broken even right now. And rates keep climbing. So right now, you can see how aggressively sometimes they increase the interest rates in this game. So like that is the one that like right here. Here I'll drop the bit of the valley. You can see the valley over here. So like the valley is over here. So like this is when I sold a lot of my bonds, because if interest rates were to stay low for a while, it would actually make more sense for me to keep my bond over the long term, because it potentially would make a lot more sense, because I was making cash flow for 19 years at about 12%. But it made a lot more sense because potentially sometimes in this game, interest rates go up really, 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 really fast. So I was pretty glad I did that well. And so now we're going to start buying up little bits of bonds every now and again. And keep in mind, we have an allowance coming due by 2025. So we're going to do pretty well. ETF. How are they doing? Like $51 a share right now for the ETF. I'm so bummed out that I didn't have margin to take advantage of this opportunity. I'm thinking the same thing would be for the other bond fund. So we were paid by DB. Deutsche Bank paid us back in full. So right now we're at a whopping load of cash. So right now it's time to be a little bit aggressive. So right now about 7.5%. You can see how fast interest rates rose. Generally, whenever I see interest rates or stocks go up really fast over a short period of time, I'm thinking that might not be sustainable. Like for example, a great example would be for example with Kodak, this company right here, like they were chilling around the $3 level. And then a big announcement came up that like I think they had like a contract with like the government to make drugs or something. And look, it just went up like a few 100%. It went up like 1,000% in like a few days. And then it went up to $21. And then it just fell ever since then. $6 and then $10, and then now it's just been chilling around the $7 range. But like that was just crazy hearing that news. I was like, oh my gosh, what happened to Kodak? I kind of wish I bought some shares. But I knew just because it went up that much in the short term, what must come up that fast must come down, in my opinion at least. So like this is like a good example of that. And also another one would be GME. Like GME stock, you can see like how over the last year, you can see how fast this thing grew. It went up like 1,000% in a few days. It went to $300, and then a few days later, with regulation, they did fall quite a lot, and then they went up a lot, and then they fell. Like eventually, it's not going to be sustainable, and so right now they're chilling at quite a high price. But like that's just because right now we're going to go ahead and lock in a bit. We're not going to be greedy and say, hey, I'm thinking rates are going to go up from now on. We're just going to be a little bit cautious though. because interest rates are likely to go up, continue going up, but I also don't know whether or not they're going to go down. So right now we're just going to make a bit of an investment. 2042, pretty high duration. You can see that's going to pay us about 10%. So I'm thinking about putting $30,000, aka most of our profit that we made, into this bond at a decent return. So we're going to go buy up that bond. Go over here, buy KONI. They're going to pay us about a 10% coupon. Pretty great. And it's 907. So we're going to buy about 33 of these bonds. That's going to come to about 30,000. So right now we're going to start participating in the bond market, and I'm hoping that interest rates continue to rise. That way I'm able to lock in my $100,000 at a very, very high rate. But right now I don't want to be greedy, because I want to start locking at decent rates, because what if rates fall all of a sudden? Then I'm going to be crying because I didn't lock in at the rates they were. Basically, you don't want to be greedy. So right now I'm acting quite rationally. So we have $57,000 in cash. I feel like we have a bond due. Yeah, General Electric should pay us soon, $27,000. And when they do pay us, I'm going to put $27,000 back into a very, very long duration bond. Rinse and repeat. So right now the short bond is going up quite aggressively. Like you can see, like the upward trend is continuing to go up. 8% now. That's pretty great. A bit of a sell-off. 6%, 7.6. Oh, no, General Electric did not pay us back yet. Okay. It's like the benefits of having lots of AUM in this game is that you can theoretically lock in at very, very bad rates and still not be not get as much consequences. Let's look at our good old buddy, what was it? GN. Oh, okay, select. Oh, yeah, we have them. Yep, there we go. So here's the government bond. It's chilling at around $50 right now. $46 right now. And, yeah. That's just because rates have been kind of flat lately. Okay, so we got our payment of $27,000 from the good old General Electric. So let's go buy up another long duration. The other mistake I made last series was also I bought a lot of investment grade. Like I bought a lot of triple A's, a lot of single A's. So this series I'm going to be buying up more triple B's and trying to see if that breaks me through my record, because triple B's pay a lot more than a little bit more than the single A. Triple 11% return. Let's put 30K into that. Buy E, 2042, 30,000 divided by 695. So I'm going to buy about 43 of these. So now we can see that we're quite balanced when it comes to our investment approach. We have about $100,000 in cash, but we're also participating in the bond market by buying long duration bonds just in case if rates do go down. So right now we're kind of playing both sides. We think that rates are going to go up, or we think that rates are going to go down. You want to always play both sides, in my opinion, whenever it comes to investments, because basically you want to be able to profit off both opportunities. Because life is uncertain. I don't know whether or not rates are going to go up or down, but it's still nice to profit whenever they go down, and it's still nice to profit whenever they go up. So right now, I would be a little bit more bummed out if rates fall. But at the same time, if they fall, I'm not going to be whining a lot, because we're going to make a decent amount of return. So they've been kind of flat lately, which has me a little bit worried that like there's either going to go up a lot or they're going to go down a lot. Okay, so we can see major tax increase enacted. The government has raised corporate income tax to 24% to promote tattoos for all citizens. So like this is seen as like a bit of a restrictant on the economy growth, because typically whenever there's higher taxes, it means basically people have less money to spend because I'm zooming in. They have less money to spend, and also they're getting tattoos. So that should mean that interest rates are going to fall over the long term. I see a bit of a downward trend, so we're just going to go ahead and play a bit cocky. Hopefully this doesn't cost me the series. We're going to buy up a lot of a very, very long duration bond. We're going to buy this bond right here. So hopefully over the long period of time it falls. Buy up 123. We're going to buy up $103,000 worth of their bond. And so now we have about $162,000 in bonds, barely any cash. And here's our cash flow. We're making about $16,000 after tax. It's 11. So right now I'm betting that interest rates are going to fall. I'm very, very bearish on how the economy is going to be. And it looks like there's a bit of a downward trend in the short bonds, so I'm thinking I might be right. If I'm wrong, it's going to hurt a lot. Because we bought very, very high duration. But if I'm right, we make a lot. Looks like I'm kind of right in the short term. Oh, never mind. Where are the analysts thinking? That's usually like what I think sometimes. High interest rates and very low tax rates. So I'm gonna keep my bonds long term. Worst case scenario, rates go up. We put our how much? We put our $11,000 after tax towards buying up more bonds. So right now we just become patient. We wait. We saw like interest rates went up a lot, and then now they're kind of like flattening out at a decently high interest rate. They're not very, very high right now, though. When they're very, very high, like around 10% or something, I know I'm pretty confident that over the long term, rates are going to fall. But right now they're at quite high to medium levels. So we're just going to keep these bonds for long term, for cash flow. Like worst case scenario, I keep all these bonds for until the duration. So like that's why a lot of the times you have to think in your head, am I okay with holding these bonds into 2042? Because a lot of the times you don't want to try to time the bond market and be like, oh, I think rates are going to fall. Put all your money in a bad rate. You want to ask yourself, am I okay and comfortable with holding these for the long period of time? So like this buy right here is quite speculative because I did a large amount of it. A large amount of my money in that trade. But if it works out, we could potentially make a giant profit. But if rates continue to go up, we're in a lot of trouble. 6.09, 5%. So you can see that there is a slightly on the downward trend. 5%. You can see my chart. I had a bit of a explosion in price lately. 4%. So like they tanked. So like that's great. So like now they're starting to hit like kind of like the old support. So they're probably not going to go down this low. If they go down this low, I will be rich. But at the same time, I'm going to start taking my profits. Okay, time to take profits. We have 13K in gains. 35K. Let's take some of these smaller profits. 43. We're gonna make about 35K. Capital gain of 5K. Not bad. I just want to bump up my liquidity just in case if rates ever do go up. That way I'm not in a hard place. So right now we're at 75K in cash. $117,000 in one bond, sadly. So I want to make sure this company is financially stable. They're still BBB. They have $2,000 in lines of credit. 20% ROE. So they're really good at delivering value to shareholders in the return on equity department. They have quite a lot of debt. A little bit higher than Warren Buffett likes. Decent track record for earnings. And they're expected to do way better than last year. But the only problem is they don't have a lot of liquidity, but that'll likely get better with their earnings. So it's a pretty great company that I'm holding. Pretty great bond. Low-key wish I could buy the stock, because that stock seems pretty decent. Like, if they had less debt, I would ideally buy them. Buy equity in the company. $19,000 in gains. Okay, I think our rates are starting to flatten out, so like that has me a little bit worried. So we're gonna go ahead and take our gain of almost $20,000 and just start buying up low duration bonds. Oh shoot! I didn't show you guys the capital gain. That was my bad. You can see right here that we have about $11,000 in tax minus for prepaid, so we should have $9,000 to spend, or $9,000 in tax. So we're almost at the 200K mark. So once you hit 200K, you're actually allowed to borrow money. And then at 300K, I think you're allowed to short sell. So right now, I'm just going to chill. Sadly, interest rates fell a little bit, and then they rose. How good is my buddy Mr. Government Bond doing? Want to see the chart. Yeah, so the chart's been on the uptrend, as you can see, because rates right now are quite low. So like that, this is when I would hypothetically, right here would be where I would cover my short. I would make 69 rate, 60 is right where I bought, where I sold my short, and I would make a decent profit. Minus the only thing that's bad about shorting though, the big bad thing about whenever you short though is whenever you short, you have to pay dividends. So if you look over here at the company, this company, the dividends, where is it? 4% dividend yield. So sadly, I would have to pay people who actually own the shares of the company every quarter. I would have to pay them their dividends. So like that's the big problem about it. So like that's one of the biggest fears about like shorting. It's because you actually have to pay the dividends whenever you short. Banks grow more aggressive. Okay, let's look for a very short-term bond. So as of right now, it's 2025. Let's just say 2026 because it's almost the end of the year. 2028, 2026. $2026. 2027 bond wouldn't be a bad idea right now. Right here, Progressive Insurance, 5% coupon, pretty decent. We'll be making about a 10% return over a 2-year period. 5% a year. So let's go and buy up some of that. We'll buy up 25K. This will be our allowance. It's a short-term bond. For only 2 years, right? Yeah, it's for 2027. 25,000 divided by 1015, so it should be 24. We'll buy up 25 of them. $25,400. So right now we're making a lot of bets. So we have 25K in short-term bond. So I'm gonna start buying up a little bit more short-term bonds just for a little bit of extra cash flow while we wait for rates to go up higher, because it may take a while for them to go up higher. So I'm gonna probably put 100K in short-term bonds, and then we'll keep 100K in cash. 2027, where were you? Just saw you. Progressive, we already bought you. Let's buy up some triple Bs. 2027, 2028. Yeah, that would be reasonable. Kaiser Engineering, 7% coupon, pretty great. Below par. Okay, I'll buy up. How much money do we have in cash? Ooh, I'm gonna put about 50K in that company, and then, you know, we're just gonna keep the. I'll probably just keep the rest in cash, just because I want to try to keep a margin of safety. And 9, 8, 50 of them. 50,000 almost. So now we can see that we have $75K in short-term bonds. These bonds are due by 2027 and 2028. So the great thing about them is in the next 1 or 2 years, we should be able to get paid in full if these companies don't default. And for the time being, we're making a bit of cash flow. That's the one reason why I actually like dividend investing. Dividend investing is just buying up stocks, but while as you wait for capital gains, you get paid a dividend, which is pretty nice. But bonds are much safer than actual stock. And I'm gonna put 23K and just mess around in a growing company that has a corporate a convertible. I'm allowing convertibles because they're a mix of debt and like they're considered a bond, but then again they're also considered basically they're considered a bond, but you can actually convert it to stock. And I'm counting that in this series. I counted in the last series, so I think it's pretty decent. 2036, 2027, 2028. That's expensive. So I'd have to sadly go out a long way in order to make a decent profit off these convertibles. So like it probably makes a lot of sense just to buy them at low rates. Watson Pharmaceutical, 2028. I feel like this is our best bet. Sadly, it's a junk bond, but they may be able to continue growing at their earnings. $2 in earnings. Sadly, they have a track record for losing money in the past. 6 times earnings, though. It seems like a very, very cheap dividend company. It seems like a very, very cheap company. Dividend yield 1.1%. They have a lot of debt, 1.2 to 1. So basically, they're born on $1.28 for every dollar they have in their equity. $0 line of credit, sadly. So if they're expected to make a lot of profit though, 76 cents. It's quite a decent amount of profit. So that should be able to, they should be able to do pretty well. So I'm just gonna go ahead and speculate in this junk bond. I'm gonna buy up 25K of this, and then we're gonna stop buying bonds because I'm thinking over the long term rates are gonna go up. So buy up 24 of these bonds. So I'm technically cheating a little bit by buying convertible bonds, 24,900. So we have Watson, which is known as a CV, which is convertible. We have Kaiser, and we have Progressive. So the great thing about these bonds are, as of right now, it's 2025, almost 2026. And we have a bond for 2028 and a bond for 2020. And then so like these bonds are all 1 year, 2 year, 2 year. And then the great thing is we have about $100,000 just sitting in cash. And the great thing with those bonds are they're paying us a decent coupon. And so we're making about $6,000 a year. After tax cash flows of around... Okay, so after tax cash flows should be around $4,000 to $5,000. So I'm hoping that over the long term that we're able to make up some great investment choices. Okay, so right now rates are as low as I could ever imagine, so like, that's pretty great. So we could potentially sell some of these bonds for a decent gain, but at the same time I'm holding them for a bit of a allowance. Spokesperson at Watson says that the company is projecting significant cash flow deficit in the next few months and may be forced to liquidate its assets. So right here, like this is the cash flow statement. This is a new addition to the game. Net profit from business operations, 114. $0 in interest they're receiving. They have interest expenses of 25,000. I know 25 million. 7 million on their variable. Oh no, this is their variable. 25 million on their variable. So if interest rates are going to go up, it's actually going to hurt the company because a lot of their debt is actually coming from a variable loan. And so then, like, their taxable is 81 minus their capex. Is this their capex? Net operating loss benefit. Oh, okay. So like this is their old losses, I guess. So they're making about 81 million. Planned capex is 25 million. So that's them investing in property, plant, and equipment. Change in working capital, negative 65. So, damn. So basically, they're expected to make $81 million in earnings, and they're spending $138 million on investing in their business. So they're going to be paying off their bank loans, paying off their bonds, and paying out dividends. But most of their money is going towards changing working capital, trying to build up their liquidity, I guess. Cash flow is expected to be negative, and free cash flow, current CD balance. So like they're expected to have negative cash flow, but that's not really a bad thing, because if you look over here, they're spending a lot of their money on growing their business. They're continuing to increase in working capital. They're also trying to pay off their debts and pay out a decent dividend to their shareholders. So they should be able to do okay over the long term. So now we're allowed to do margin trades, and so that's great. I don't think we can short sell though, sadly. So can we go over to our good old buddy and try to short sell? I don't think we're going to short sell. I think that's 300,000. So we look over here. So yeah, so I need to have $300,000 in order to short sell the ETF. So right now would be an ideal time to short sell this bond ETF, because you look over here, it's like almost at $80. It's at 78 right now. So right now would be a great time to short it, but sadly I need an extra 100,000. So right now rates are at rock bottom levels. Oh, okay. So we have $94,000, $100,000 in corporate bonds, which are due in the next few years. So we're gonna do all right. Now it's time to just let time roll out. Hopefully interest rates will go up over the next few years, and then we're going to be able to get our allowance and then be able to invest in some very, very great assets at very, very good rates. I am very, very sad that I did not short this ETF. I would have done pretty well. That's like, it's down $3 so far. That's gonna be part of my new strategy too, is shorting. I'm gonna do a bit of a long short strategy, but with bonds, and have a little bit of fun with that. Because right now I'm believing that interest rates are likely to go up, and they are. So right now we would have made potentially $10 in profit. Pretty great. But sadly I missed out. And it would have been a decent amount. So right now it's at 3%, almost 4%. So we're at about $96,000 in cash. We have $6,000, $5,000 in after tax. 25K is coming due soon, so we should have expected cash flow of $125,000, $29,000 with our interest. So we're gonna be having about $125,000 at the end of the year that we can just put towards buying bonds. So hopefully interest rates go up in the next year or two, and this trend continues, and I'm able to continually make great investments. I'm gonna turn up the music. Oh, what's up? Oh, this is crazy. We already made $13,000 off the convertible bond. Okay, it's like I'm technically, this may count as cheating, but at the same time I'm making the rules because it technically counts as fixed income. So look over here at the actual stock of Watson. You can see right now they're at $65 a share, so I'm thinking they're a little bit expensive. But like, look at their stock right now. I think I bought the bond around here, and then the stock has been going up, so I'm buying a bond, but at the same time, again, success of the company. So that's the great thing about the convertible. So right now the convertible has just went up in price a lot, or a decent amount. So you think about it, we bought at 104, so I can do a bit of math to calculate like the return that we made so far. Subtracted by 104.15. we get about $54 in profit. Divided by 104.15. You get about a 51% return. Pretty great. So like that's why I actually like to buy convertible bonds in this game, is because you get a bit of the benefit of the rise in prices of equity over the long period of time, and you also get the safety of a bond. So like that's why, in my opinion, I personally love convertibles, and hence why I actually like to do them in real life. Like in real life, I actually bought a convertible bond because I want to participate in the stock, but at the same time I want safety of a bond. So I like to say it's the best of both worlds, in my personal opinion. You get equity and you get safety of the bond. So let's look at our potential short that we would have took out. It's doing alright, 61. Sharp sell-off in the stock market, $96,000 in cash. So look at my chart. I've been kind of flat. So like every so often, my portfolio's been mostly flat lately. So like look over here, and then we have some increases, and we have some increases. It's like generally our increases come from mainly decreases in interest rates. So we're quite stable. You can see how stable our portfolio is. And if you want to look at, like, for example, an ETF that's kind of like not similar to mine. Like if you want to look at like other, like if you want to look at like the more riskier, like this is probably one of the most riskiest ETFs in the game. It's called the Aggressive Growth Shares, triple leverage. You can look at how volatile this stock is. Look, it's just, it's not as stable. So like if you look at this is actually a stock fund, and they have triple leverage. But look out here, almost $10 a share, like almost 30. It's at 33 right now. So like you would have made a good amount of money off the market, because if you look over here, the stock market has went up. So the great thing about the triple leverage is they're taking out a lot of leverage. They're borrowing money. So whenever you borrow money in the game, you generally have higher returns, but also you have higher losses potentially if you do bad. So that fund has done really, really well. But I've been pretty stable lately. And our bonds have been hurt quite a bit. Watson has sadly fallen in price lately. I actually knew it was quite a bit of an overvalued stock at the time, so I should have sold. So like right now we actually lost most of our gains. Sad. But I don't really know. I'm gonna hold it long term. $0 in their lines of credit. $1.34 expected in EPS for the quarter. So like they're gonna do really, really good this year. So I'm just hoping that they're able to actually, yeah. So they're actually deleveraging. I think last time I saw they were at 1.20 debt to equity. They're at 1.9 now, 1.09. So they're paying off their debts. That's great, and they're growing up their business. But ideally, I want them to pay off their debts, because their debts are variable. Can you actually look at their cash flow? Oh, that's cool. I just noticed that this is actually the cash flow projections. So you can see like the 3-month cash flow projections. So like this is a great addition to the game in my opinion, because the income statement, like where like the earnings and everything, it's not including cash. So like the cash flow statement is a great way of knowing what the companies spend their cash on. So you can see right here that they're making about $183 million in taxable income, minus their bank loans of $43 million. So they have 139. Well, you might be asking like, why are these decreased? Well, typically interest expenses could be written off, so that's why it's not. That's why it's deducted. It's deducted. So we have $139 million in taxable income, rough estimate. And then the benefits are zero for their previous losses, $139 million. They're expected to capital disinvested. So like this is a bit of a red flag potentially, but it's also good for the company because they're highly leveraged. They're actually selling their property, plant, and equipment. So they're selling about $25 million of that. They're changing their working capital. They're paying off $40 million of their bank loan, and they're paying a $5 million dividend. And so Oh look, they're actually cash flow positive. So they're actually expected to make a cash flow positive. They're expected to be cash flow positive. Projected cash flow cannot take account possible purchases of assets or result in. So I'm hoping that that cash flow projection is correct, and then they're able to basically be able to do well. So right now rates have been kind of going up a little bit, not as aggressively as last time. See, like, oh wait. What wasn't I glad that I locked in around 8% and not been greedy? Because if I was greedy, I would have said, "Oh, I could have made 12." Well, when I could have made 12, I could have theoretically lost out on those gains. So, like, hypothetically, the 8% rule is my favorite because that's considered a high rate. And worst case scenario, rates continue to go up, your bond value drops, you're able to reinvest your cash flow into higher coupon yielding bonds, and then whenever rates do fall, you're going to be alright. Government has raised corporate tax to 22% to expand vacation time for postal workers, so hypothetically, interest rates should be going down. Yeah, they went down. So let's go ahead and just put like maybe $25,000 towards buying up all. Let's just buy up the government loan bond. I'm gonna buy about 24,000. So this will be a bit of a short-term play on potential interest rate decreases. Could have theoretically bought more, but at the same time, interest rates are already quite low. Okay, we'll have like 172,000, so that should give us a decent return. How are we doing with our income? So our income, we have about $1,000 receiving every year. 5,000. So we're doing alright. We're expecting to make 103,000 by the end of the year. That's pretty great. That buy of the corporate bond though wasn't doing too well because interest rates are continuing to rise. But if they would have kept on going down, then that would have been a great trade for me. Would have been pretty decent, not perfect. How's our good old buddy, Mr. Government Bond? You're kind of staying flat, so I would have sold around there, and then I would have directly kept right here. I don't know. I'm kind of excited for when I hit 300k. That way, I'm able to play around with the long-short strategy a little bit more. Hopefully, be able to hit a higher amount. So far, we're at year 6. We really haven't hit much for momentum. I think once you start hitting $1 million in this game, then your momentum starts to lift off and you get really good. Also, a lot last time, I also leveraged a lot of my money. Whenever I thought rates were very high, I would leverage a lot of my money. I would borrow a lot, and then I would sell at very low interest rates. So I think I got more luckier. It's a very slow start though when you play bond only. But once you start like hitting about $1 million, then it starts getting interesting. Because right now I'm making only a few thousand. High silver is ending soon. How's our government bond doing? Watson is doing alright. Government loan bond, we made about $900 in capital gains of a $25,000 investment. Not bad. So we have like a lot of cash right now. We are like 100k in cash. Daewoo Motors is a loser in the product liability litigation. In the major product liability Basically, damages for a class action lawsuit, 3.844 million, being 3.8 billion, and that made interest rates go up. And so now we actually lost most of our profit, sadly, off of our government. But if we look at Watson, Watson's just going crazy, man. Watson's at $78 a share. Jeez, man. So Watson's actually doing pretty well. Like, this is when I was considering selling it, and it dipped, and then it rose, and it rose. So how was Watson doing? We're at $300 million in cash. A bunch, like, they're actually quite overvalued. Interest rates are likely to go up. They thankfully got an upgrade. That's great. Because they were selling off some of their business assets to pay off their loans. So right now they're at a debt to equity of 0.89. So they're deleveraging. So that's a great idea. So I may continue to hold up Watson. But at the same time, it's a little bit of an overvalued company, I believe. But they are great at returning shareholder value by having 24% ROE. Pretty low dividends, sadly, but a very high PE. But they got great ROE, so that shows that management is pretty great at what they do. Management is, where is it? Management's reasonably competent. They're a strong sell from analysts. Solid financial condition, is currently having credit rating of BBB and is generating positive cash flow. So I think it's about time we probably take our profit on that convertible bond and start going into maybe a little bit more crazier things. Because right now I think it's a good opportunity to just keep in cash. So we're at 150k in cash right now. Our bond portfolio, we have some government bonds just for a little bit of extra cash flow. And we have our Kaiser stock at 2028. It's currently 2027, so we should be getting our money back in a year. Watson, $1.20. So they went down a bit. Oh, went up a bit actually. I'm gonna stop tracking it though. Government bond. Oh, that's Watson, my bad. $51. Yeah, 51. So right now it's about time we go ahead and start making some investments into some lawn bonds, I guess. Some corporates. Maybe. Yeah, I'm not gonna be greedy. We gotta make a little bit of investments. Beckin Dickens. $400 million in cash equivalents. They're easily able to cover their bond, but their bank loan is variable, which has me a little bit worried. They are quite solvent. They have earnings losses a lot of the years, so like that's hence why they're probably considered B. But they're able to make a lot of profits, and if their cash flow is good, then they might be able to make a comeback. Because if you look at the stock, their stock is probably depressed right now. Semi. $42. Okay, earnings profile negative 19 million. Expected to make 55 cents a share, so that's pretty decent. Well, how about their cash flow? So if we look at the company, company profile, cash flow projections. You can see right now that their net profit from operations is 117 plus their interest, 124 million, minus their taxes, 101 million, 23 million. Yep, they have some tax losses. They have some tax loss carry forwards, I guess, because they've been losing money every year because they get like a deduction on that. So we can see right here that they have $27 million in after-tax cash flow, but they're actually disinvesting a lot of their money in basically selling off their assets. You can see right here that they're expected to have a bunch of working capital and everything. And you can see right here that like it's negative 40 cash of CD balance, so they're expected to lose about 13 million in negative cash flow. they'll be at $465 million in cash. We could theoretically just look at their cash and just calculate like how much cash value they have. 478 divided by 50 million shares outstanding. The share prices based on cash should be at $9. So I think $32 might be a good buying price, but right now it's a little bit overvalued. And they're considered junk, so like that has me a little bit worried, and they're not very good return value to shareholders. So it might not be a good bond buy at the moment. And the management apparently has no improvement. Okay. Right now it sucks because like we're in moderate interest rates. So like I'm not making, I can't make any super good investments right now. How much cash do we have? We have like 100. Yeah, let's put like 40K into something like a very short-term bond or something. What year is it? It's 2027, right? 2027, yep. 2028, right here. PNC Financial. Let's go and buy up a bunch of this. Let's buy up like 50K of them. And then we're gonna keep like 100K in cash just for opportunities. $50K divided by 990, about 50 bonds we're gonna buy. That'll be about 50,000, almost 50,000, like 49,560. Pretty great. So we can see right now that we're at like a decent amount of portfolio. We have basically some government bonds for cash flow, which are sadly getting hurt really badly right now. And then we have like we just bought another short-term bond for 1 year that's paying us an 8% coupon, trading for a discount. So I'm pretty happy that I made that investment. And we have a lot of cash right now just for opportunities. So I'm hoping that rates continue to rise. So right now we're basically playing around with mid-interest rates. With mid-interest rates, sometimes I just like to play around with... I should be buying up mid-term bonds right now, but at the same time, I'm a bit more... playing a bit more cautious because I'm thinking rates could be going up. But then again, GDP is almost in negative right now, so that potentially could be there's a sell-off in the whole bond market. So let's go ahead. Oh no, I don't want to buy stock. No. You know what? Let's go ahead and take a bit of a risk. We're gonna go ahead and borrow. We're gonna go ahead and take out $100,000 of non-callable government bonds. It's going to buy with 98 of these. And they're 99,000. We'll have to borrow 2,000 sadly, but that's okay. So right now we're betting that interest rates are gonna fall over the short term or over the long term. So right here we're making about expected cash flows of 9,000 plus our maturing proceeds. So we're doing all right. We have quite a balanced portfolio in my opinion. Like it looks pretty bad because I have a lot of my money in corporate bonds and government bonds. But we look over here, our corporate bonds are maturing very soon. With our PNC at 50K and our Kaiser at 50K maturing soon. So we're gonna be getting about 100K in cash. So I'm playing both sides right now. I'm saying I'm bearish on interest rates right now, and I'm also bullish on interest rates right now. So right now I don't know what GDP is gonna do. GDP is likely probably to go negative unless the economy makes a giant turnaround. Yeah, it's negative. So if it stays negative for 2 consecutive quarters, that being 6 months, that means that the country's in a recession and likely interest rates are going to fall. And so that's why I'm playing both sides right now. I'm playing short-term bonds just in case if rates do go up unexpectedly. And I'm also playing with long-term bonds just in case if rates do go down. PNC slashes dividends, doesn't matter because I own their bond. They can't slash those bonds. And we can see right now that we are at a slight uptrend. How much have we made off our bond? Our corporate bond, we made about 6,000. And our short terms, we actually lost a bit. We're at 2,500. Our cash flow, 8,000 after tax. So we should be having about $110,000 by the end of the year. That's about half my money in. So I have about half my money in long-term bonds and half of it in short-term. So there's a bit of a sell-off in the bond market right now, which ideally I want. So like there's a bit of a, yeah, it's a bit more of a downtrend. It went up. Yep, GDP is negative again. It went positive briefly and then went negative again. So if it continues to stay negative, that's going to mean that like interest rates are going to likely stay low for a period of time. So that's going to be very, very good for our government bond. But we do have cash. We have quite a bit of cash, or at least near cash investments like this Kaiser. So we're doing pretty well. We're mostly weighted towards we're mostly weighted towards interest rates falling though, sadly. Oh, GDP went positive. Negative again. So it's just bouncing between negative and positive GDP. That being like the economy's health is doing okay, not doing okay, doing okay, not doing okay. It's just ping-ponging. If I look at the support and resistance, it looks like it's kind of hitting like a bit of a support line. If it falls below the support line, it could potentially hit very, very decently low interest rates, and I could make a lot of profit. Or it might be a good idea for me to take profits because I don't know what's going to happen with the economy. What are they saying with the whole thing? They're neutral, so they have no clue. And so I'm hoping that GDP maybe stays negative for a period of time. That way I'm able to make a bit of money off my corporates. No, my government bond that I just bought. Should have bought a corporate bond though, because they have a higher coupon. You could potentially make a higher capital gain. But government bonds are much safer. Okay, GDP is negative 1.1, so the economy is deteriorating in health. So that means that they should be able to lessen the interest rates. Nope, they're neutral still. Gold's depressed. Oil's quite depressed. Silver. Almost all the commodities are depressed right now, which means that there's not a lot of inflation. Because whenever commodities typically go up in price, that means there's inflation, or at least expected inflation. So we're doing pretty well for a bond portfolio. I'm pretty glad about that government bond. Because now the financial health of the country is fallen quite a lot. So some companies actually might go bankrupt. So I'm pretty thankful I didn't buy any junk bonds, because with the economy being this bad, earnings are probably going to fall, and that will make maybe some companies go bankrupt. Okay, I'm going to go ahead and take my profit on this government bond, 23,000. And I'm going to go ahead and buy up a bunch of short-term bonds just to play around with the potential increase of interest rates, because I'm a little bit afraid of that. So we're at $205,000 in cash. We're almost going to have $250,000 in cash coming due. We have margin debt, which we're paying a very, very high rate. How much are we paying on margin debt right now? I should look at interest rates, not economics. Consumer loans. Prime mortgages. I think it says in the this thing. Yeah, so we're paying 5.25%, so that will be known as the, what is it, the prime rate? Oh yeah, yep. So I'm paying prime. So prime rate is the interest rate those charged to loans of their best customers, those with AAA credit ratings. So right now I'm gonna pay off my loan because I don't need the loan. So we're gonna pay off $2,500. Bam, it's gone. So now we're at $203,000. So right now we're betting that interest rates are gonna go up over the long term. But I'm gonna play around with the short term a bit. We're gonna go ahead and buy up a bit of a short term bond, 2028. That's good to remember. Okay. So I'm looking for some 2029, 2040 bonds. 2029, 4% coupon. A decent profit margin on that. 2041, 2029. Let's go and buy up some of this. Hong Kong, Shanghai. Sadly, it's not going to pay us much. But at the same time, it's going to pay us something, which is great. It's better than what we're going to receive if we just keep our money in cash. But there's a slight chance of default, but it's a AAA. It's like an A grade company, so they should be fine. Let's look for a little bit lower of our credit rating. Now we will make a bit of a slight higher profit. Okay, so we're looking for like a 2029 bond or something. $2028. That's today. 2030. Is it really that? This one might be good then. This one. So if it's 2030, yeah, so that's about 2 years out. So let's go ahead and buy up a 2-year HARH bond. How much was my allowance? I forgot. I don't want to buy up all of it because we're in a lot of trouble if we do. 200. So I want to put probably 50K into that, and then probably put 50K into a NAR bond. Because I don't see interest rates going up in the next 1 or 2 years, so might as well lock into a bit of some short-term bonds. That way I'm able to make a bit of a... Oh, that was my bad. 50,000 divided by... Oh, you guys can't see that. My bad. 49. Let's buy 50. Let's go a bit above budget. It's okay. 50,600. Okay. So now we can see that we have... And I want to put an extra 50K into a... So we're going to look for a 2029 or 2030. Ideally a 2029 one. 2030, that's pretty decent. I'm looking for a bit more liquid though. 2029, Lear Corporation. 8% coupon, a bit below par. Pretty great. It'd be great probably to buy the stock right now, honestly. Maybe. 13 priced, 13 earnings. They do have quite a lot of variable rate debt. But they do have a line of credit, so they could theoretically borrow from the line of credit to pay me back. So that's pretty great. Or they could just reissue more bonds. So let's buy up some Lear. I'm gonna buy up 50K. Right? Is that our budget? I think we have 25K or 50. I believe it's both. 50K, yeah. So 50K is gonna go to Lear bond. Hopefully they don't go bankrupt because this strategy relies on solvency of a company. And their ability to pay you back. If you're very pessimistic in this game of the economy or companies, then you want to keep some cash. So that's why I'm trying to keep a bit of a 50-50 picture between cash and short-term bonds. So this cash is basically meant for protection. If interest rates go up a lot, it's meant for opportunities too. But like these short-term bonds are meant for a bit of some extra profit potential. Because I think in the next 1 or 2 years, interest rates are going to stay low. So we might as well make about $6,000 after tax. And so now we're expecting to make $153,000 once our mature bonds come due. So I'll continue doing these short-term bonds for 1 or 2 years until I think rates have hit a decent level for investment. Okay, they sadly lost money. The one I put 50K in, they lost 7 cents a share or $7 million. So the economy isn't sadly doing that well. So like, would have probably made sense to keep those government bonds, but then again, I don't know whether or not rates are going to go up or down. Okay, the economic depression is getting worse, so like we're in -3 for that. Yeah, so interest rates just keep hitting low levels, and they may stay low for a while. That's what I'm a little bit worried about, because it might not have made sense to sell my long bond, but at the same time I wanted to play safe. 4% negative GDP growth. Gold's a good price right now. Grains are down. Basically everything's depressed right now in valuation. Right now would be a good time to buy up some material. Oh, there's like a good sign that maybe the central bank has changed their mind. No, they're still neutral, but interest rates did take a bit of a spike up, so that's good. And then they're back down. GDP grew a little bit, but like still they're negative. Interest rates went up a bit. Interest rate went up a lot. That's good. Down a bit. Hopefully we get positive GDP growth. That way we're able to continually make great investments. $150,000 in cash. Sadly, we lost a bit of money on our short-term bonds. It's not a big deal. Okay, so now it's like we're in moderate interest rates. So once they start hitting maybe the 6 or 7 or 8% range, I'll start buying up some corporates. I usually like to buy corporates in this game at the very start whenever I think it's a decent idea. So like around the 5 to 6% range, I like to buy corporates because sometimes you make like 8%, while as with the governments you make usually less than the amount they prescribe you. So like that's why I usually just like to use the corporates as extra cash flow to reinvest into more corporates. And then whenever I'm taking out a very risky transaction, I'll use the government bonds because those are almost default free. So if I'm leveraging a lot of money, or if I'm putting a lot of my money in one asset, I'll buy up the government bond in this game. So interest rates are going up quite aggressively, and GDP is starting to get conflicted. It's like, and commodities are actually going up in price. Like oil is going up quite a bit in price. So that makes me think that so like look at the grains. Grains have gone up a lot. Your oil has gone up in price. Your gold has gone up in price. So that reminds me of like kind of what we're going through right now with the whole commodities. Like if you look at the stock market, I believe was one of the first things to recover from the coronavirus pandemic. And so generally whenever there's a rise in commodity prices or a rise in the stock market, generally it means that there's inflation coming in the future. And now we can see that nowadays that inflation is starting to rear its head, and I believe that is primarily just because a bunch of people made investments then, and people are expecting inflation. But people are saying that this inflation that we're going through in real life is transitory. Like it's not gonna stay long, but it may stay around for a while. Okay. So now it's about time I kind of act like hungry hippos and start gobbling up investments. So right now we have about $150,000 in cash. We have about right now it is, so we should be expecting a bunch of money next year and the year after. Pretty great. And so we should be expecting $100,000 in the next year or two. And so right now we want to be kind of conservative. I'm going to put $50,000 into a long corporate bond. So we're going to buy up a very long duration, triple B. 2039, 2040, 2040. Oh, 2048. Damn, that's a very good one. Yeah. So we're gonna buy up Shin Kong Insurance. Sorry if I pronounced it wrong. Buy. So then we're gonna go ahead and put 50K into this bond. 50,000 divided by the price. So the price is 983. I'm gonna buy about 51 of these. I'm gonna go a bit above budget. $50,200. So right now we have about $146,000 in corporate bonds. We have a bunch of money coming due next year, thankfully, and then we have a bunch of money coming due in the next year after. So that's pretty great. And we also have a lot of cash. That way we're able to make great investments. So if rates hit 10%, I'm gonna be locking in $100,000. So you can see that the short bond is going up aggressively right now, going up very, very aggressively. So right now I'm quite bearish. I don't know, I'm quite bullish on interest rates maybe going up in the future. But at the same time, I want to play both sides. Hence why I just bought a bunch of this bond right here. So that $50,000 bond is going to pay us about $8,000 after tax, and we're expected to make $161,000 in cash. Pretty great. Yep, interest rates continue to go up aggressively. Oh, very aggressively now. Damn, that's rough. Okay, let's go ahead and do 100,000. I don't want to be greedy and wait. 14%, 2041. That's 2048. We already checked that one out. 2040. Basically, I try to look for like the highest number on the year as possible. So 2048 was like, damn, that looks very good. 2040 doesn't look bad. And sometimes I like to relate them to others. For example, like this pays 14, this pays less, this pays more than that. I can't find any super duper long duration ones besides that one company we just bought. There we go. So 14% Applied Materials, 14% coupon. Solvent, triple B. Earnings is 0, sadly. Let's go and buy up some of that. So right now we're not gonna be greedy. We're gonna lock in 100,000 at $690 a bond, 145. I'm gonna have to borrow a little bit of money. Nope, we're good. So right now we have almost $0 in cash. So right now we have Lear, which expires in about a year. So it'll be ideal if interest rates stay high for the next year or two. That way I'm able to invest $100,000 at a very, very high coupon. And then we have like this investment, which is going to pay us a decent amount. And then we also got Applied Materials, which is a pretty high coupon. So now our expected cash flow went from about $8,000 to $19,000. So I'm going to reinvest that $19,000 towards higher coupon bonds if rates rise. But if rates fall, these two bonds are going to do well. These two bonds aren't going to do so well because they're short term. So my capital gains are potentially very, very capped. Whereas these, my capital gains are very, very high. So we're doing pretty well right now when it comes to our management style. So right now I'm just going to chill, wait for my bonds to expire by 2029. And then we're going to continuously make great investments. Sadly, rates are starting to slow down, so right now it might be a good opportunity to continually lock in more. Let's just do a bit of the lawn. It's trading for about 80. So we have about 3,000 something. I'll just do 4,000. Gonna buy about 5 of these. Borrow a bit of money. Yeah, we'll borrow $240. It's not a big deal. Our cash flow can simply pay it off. And right now we have no cash, but we have a bunch of short-term bonds coming due. So we're pretty well capitalized and pretty well positioned for higher rates, lower rates. I'm okay with either. 3 cents versus 6 cents. Oh, okay. Rash of suicides and disappearance of financial executives continues. Authorities mystified. This week, the CEOs of 2 major banks have died unexpectedly. Both men in their early 40s were thought to be excellent physical and mental health. One committed suicide by leaping from an 11th tower of parking structure, leaving a no suicide note, while the other was found dead at the wheel of a Lexus with the engine still running. Apparently dead from unexplained lethal dose of radiation from an unknown source. Previously, some alternative news sources on the internet had pointed out that that over 90 top banking and mortgage executives had either died or been killed or disappeared in the last 6 months. These two are yet more examples of a large number of high-ranking financial executives and governors at the Federal Reserve Bank of Dallas who have either committed suicide, died under somewhat suspicious circumstances, or similarly vanished recently. In most sensational of those occurrences, the Dallas Federal half-eaten body was found in a lion enclosed in a Fort Zoo. Fort Worth police said foul play was not suspected, however. Officials at Interpol had no comment on this strange skein of ultimately deaths and disappearances of high-profile bank and mortgage company executives. The FBI officially told CNN that there was nothing out of the ordinary out here. Anyone who says these events were related to the fact that these guys were involved in... Okay, so this is the key stuff. Involved in the subprime mortgage securities businesses, which is booming, is yet to be damned conspiracy theorist. Some of these conspiracy theorist websites have been making outlandish claims lately that their whole subprime mortgage program, where the government is requiring the lenders extend credit to low-income individuals regardless of their ability to repay, is a fraudulent house of cards and is about to collapse again as it occurred in 2009 and 2022. So 2022 being fake and made up, but it actually happened IRL in real life in 2009 with subprime mortgages. There was a collapse. However, government officials say subprime mortgages are not the problem this time, and there have been relatively few defaults in the newly liberalized program so far, so there is nothing to worry about. Well, like, there's actually this one big fear. Oh, okay. I couldn't find it on the internet, sadly, but one of the things that, in my personal opinion, is if you hear the words "this time is different," "this time is different," you hear about that almost all the time, and almost all recessions happen because people believe this time is different, and like that's what they're thinking. This time is different, so I'm gonna be a little bit more aggressive in my bond buying strategies right now, just because I believe that interest rates are gonna fall because of this subprime mortgages. People are gonna, like, GDP is likely to continue collapsing, and then interest rates are likely to continue to fall. Plus, GDP is low. Bank regulators say rumors of subprime mortgage crisis are overblown. They might be. We're at about $1,000 in cash. So let's go ahead and just buy up like let's just buy up 2 of these bonds. We're slowly just gonna buy up little bits of bonds every now and then. Oh, we have about $1,000 in margin debt, $5,000 in government bonds. So our expected cash flow, $19,000. So we're expected to make $66,000 by the end of the year. $50K of that coming from our return bonds. So hopefully rates continue to go up over the next year. But I'm thinking over the long term, rates are likely to fall. Who knows? I could be wrong. We're at 8%, 8.4% on the short bond. It's going up very, very aggressively. It's making it a very, very good investment for me, potentially. So, like, that's why I like this game. Like, the story and everything. Like, there's a story right now with the whole subprime thing going on in this game. So I feel like that's potentially a very, very interesting thing. A while back, like a year ago, or like 2 years ago, I don't know, a year ago when I first started this channel, I dealt with like this, we dealt with like $500 oil prices, and that was ridiculous. And there was defaults left, right, and center. Tons of companies went bankrupt during that period. And there was like complete anarchy. And I had to sell my individual stocks and go into government bonds because I was generally afraid of losing my money. $50,000 in cash. Pretty great. What is the central bank thinking? They're still tightening. So right now, how invested are we in long bonds? Because I want potential for upside. We have about 40,000, 47,000, 41,000. So we have about $80,000 in. No, we don't. We have about $140,000 in long duration bonds. So $140,000. Oh my bad. I'm just doing 140,000 divided by 244,129. So about 50% of my entire portfolio is in long duration bonds. Interesting. 55,020 divided by 244,129. 22% in cash. Regulators tell banks to increase reserves for bad subprime mortgages. Okay. Okay, so right now it's about time we start going into very, very long duration bonds. Just because I feel like regulators are starting to regulate the environment, so that's going to make the subprime mortgages a little bit less profitable. So over the long term, I'm thinking rates are likely to fall. Let's look for a very, very long duration bond. 2046, Applied Materials, already bought that. I do not want a lot of exposure to one or two bonds. That way, if there is bankruptcy, I'm in a little bit less trouble. 2048, already bought that. Oh, damn, they got downgraded. That really sucks. Honeywell, 15% coupon for 2040. Hayachi, here's a good one. Hayachi Semiconductors, 2047, 14% coupon. I'm gonna buy 50K of this. In worst case scenario, rates go up. It's not a big deal because we're not leveraging at all. So we have no pressure to sell for a loss, aka margin calls. So 50K, I'm gonna buy up some of this bond. Divide by 607. I'm gonna buy about 82 of them. So that's gonna be about almost 50K. I'm alright with that. So right now we're at 4K in cash, $900 in debt. And so now the majority of my money is invested in long-term, 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 short-term. Well, I would consider like the 2040 bonds considered almost mid-term. So right now we're invested a lot of mid-term to like long-term securities. I have objectives on continuously buying up more and more long-terms. Currently 24.29. Typically in real life there's a recession or at least a downturn in the market every 10 years, and there's a correction every 2. So a correction being a negative 10% decline in prices, and also every 10 years there's usually a recession that goes on, and a recession means a buying opportunity. So right now the economy is not doing that well. And sadly, rates are continuing to go up, and it turned the value of our bond portfolio by like a lot. I'm guessing the majority of this loss, though, is coming from them getting downgraded, sadly. That's the problem, though. Like, whenever interest rates are very, very high in this game, banks are very, very high risk because they are loaning out a lot of their money. They basically have like a lot of customers demanding a lot of high returns on their savings accounts, so they make a lot less. So during higher interest rates, banks get hurt in this game a lot. So I've actually had some banks go bankrupt in that. So right now rates are starting to go in a bit of a downward trend. So right now we're just going to play a little bit aggressive and buy an extra 8k of long duration bonds. Trump Hotels, why not? 14% coupon, pretty exceptional. 8. Let's just do 9,000. Let's just leverage a little bit. Okay, let's buy 14. $9,000. We're gonna borrow $42. Woohoo! So after this, after interest rates do go down, I'm gonna go ahead and call it an episode. Hopefully. Yeah, GDP has just been negative for a long period of time, and I've looked through a bit. I've glanced at the earnings reports that I've been sent like as pop-ups and everything, and the companies I've bought bonds for, their earnings are actually going down a lot. So right now would be a bad time to buy up some stocks because there's declining earnings. But once I think it's over, I'll go ahead and get into it. Oh look! Just because they said this time is different. Fed says financial system faces full-blown mortgage loan crisis. And the economic health is getting worse and worse for the country. But hey, we locked in a bunch of long-term bonds. We're pretty well capitalized for basically any scenario. Well, not 20% interest rates, but we're going to do it right. I'm pretty happy if rates stay high for a while. If they decide to tank tomorrow, we're gonna make a bank though. Oh, we do have some earnings. Hiachi Semiconductors made about $1 billion net profit. $6,000. Let's go ahead and pay back our loan, might as well, because we're paying such a high rate. And our borrowing rate was 9.5%, so it does make sense to pay back our debt. Okay, let's go ahead and lock in, because I just saw a bit of a downward increase. It may go back up, who knows. What's a very, very long duration? 2040. Pretty decent. Some in equity. Trading for almost par. Let's just buy 10 of them. It's gonna cost us 7,000 or 2,000. Not a big deal. So here's our cash flow and how well we're doing. We're at $68,000 expected. 26k after tax. 50k coming due soon. So we should be able to put that cash flow towards good use. Buy another long duration bond, hopefully. Or just keep it in cash. Might just keep it in cash because I'm thinking rates might be going up over the long term. Or they might continue to fall. Some in equity lost to 410 million. Yay! We're allowed to do short selling now. That's awesome. So now I can start taking advantage of that new strategy that I've been wanting to take advantage of. Oh, here we go. Ha 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 ha! Here we go. I basically predicted this. History repeats itself, with banks and insurance companies, again, pledging for bailouts as high-yield mortgage-backed securities turn out to be worthless. Large financial institutions from Kuala Lumpur to Wall Street and Dubai are reeling once again as their investments of many billions in high-yielding but risky mortgage-backed securities go bad. As in the 2008 Wall Street meltdown, greed has gone to the best of these banksters and insurance company moneylenders, lured by high rates of return on securities backed by subprime mortgages. Home loans made to individuals who have little inclination or ability to make the first month's payments on such loans. Most people felt the 2008 financial crisis had taught bankers and government regulations a lesson, but apparently not, as tens of thousands of pages of new banking regulations were directed at everything but the heart of the problem. Lenders still being forced by government regulators to lend to unemployed or low or no income individuals. Another example of that is ninja loans. No income, no job, no assets. Like, that's just me adding a little bit extra. With no assets or credit history, but who had happened to live in low-income districts where lenders were required to meet government quotas for loan originations. Let me just continue with that. Lower no income, with no assets or credit history, but who happened to live in low-income districts where lenders were required to meet loan originations. Knowing full well that these were mostly loans that would never be repaid, lenders quickly packaged these loans as mortgage-backed securities that would be sold to unsuspecting buyers, typically banks, insurance companies, or pension funds that were attracted by the high yields offered to them on these complex investments. So complex investments are usually a very, very high risk investment, because if you don't understand what you're buying, basically you're putting yourself in a lot of danger. Since many of these securities are already beginning to go bad, the international financial system, as the first subprime crisis, is once again in danger of seizing up as banks and other financial institutions begin to incur huge loan losses, and panic depositors or policyholders are removing their money before the institutions belly up. These withdrawals are causing a rapid contraction of the money supply. As such, with the withdrawn cash is simply hidden under mattresses or safety deposit boxes rather than being redeposited in our financial institution. Many individual depositors fear that at this time, unlike before, the losses from bailouts may be too much for the taxpayers to absorb, and the government may instead resort to bail-ins, where large percentages of deposits or insurance policies are simply canceled in order to keep large institutions solvent, as was done in the test run by regulators in Cyprus in 2013. Didn't know this was a thing at all. Bail-ins. I'd never heard that word in my entire life. So I guess I learned something today, that there's such thing as bail-ins, and there's such thing as by regulators in Cyprus. In that liquidity crisis, many depositors saw up to 80% of their bank accounts confiscated by government edict in order to save the Cyprus banks from collapse. Damn, imagine losing 80% of your savings. That would be rough. Jeez. Imagine only keeping 20 cents for every dollar. So, yeah. So right now, from now on, I'm going to be making government bond investments just because these bonds are triple B, so they're likely to get downgraded. So we may underperform over the long term. I'm hoping that these companies that we hold with our bond portfolio do not go bankrupt. Because right now, it's a scary time in the economy. So right now, it's about time I start loading up on some some government bonds, or maybe some cash. So with that coming into effect, you can see that the interest rates are starting to tank, and thankfully our bond portfolio is doing pretty well. That was a pretty nice story, though, I'm not gonna lie. History History is probably one of the underrated things to study when it comes to stock market, because a lot of human behavior is judged by history. Banks were more aggressive in London, increasing loan limits. Cool. They're acting very, very aggressive. With their loans. So that means that we make bank offer government bonds. Look at this, freaking 25%, $25,000 gain, 19,000. Our bond portfolio is doing pretty well. Cool. Trump Hotels made a profit of 16 mil. Let's go ahead and pay off our loan. Might as well. Boom. Loan's paid off. So now we have $4,000 in cash. I'm gonna stop making bond investments right now and just chill. Okay, we got 10 years almost done. Summon equity, lost money. Sad. 200 mil lost. Look at that. We got a decent rate of return from that. We're buying around 8 to 10, and then now collapse is coming. Pretty glad I read that article. That article potentially made those two articles made us a lot of money. Fed says subprime mortgage crisis continues to worsen. So it may continue to worsen or it may not. I don't know. I'm gonna probably take their word for it because it's coming from the Fed. But then again, they may be wrong. It may be getting better. Okay, right now we made a pretty good return off our bond portfolio. So at the moment, I'm just gonna go ahead and take some profits because I don't want to be greedy. So we can see right now we made about 50K off Applied Materials, 30K off that. So I'm thinking I'm gonna cash out my Applied Materials bond, or at least take my profits. But then again, it probably makes more sense just to sell the entire thing, because right now rates are very, very, very low. So we're gonna make about $153,000 from that sale. And we made a capital gain of $50,563. That's pretty exceptional. So now we're at 150K. So now we're quite balanced when it comes to our portfolio. And we have $30,000 in gains from Hiachi Semiconductor. And then I'll probably keep the rest of the bonds just for a little bit of extra cash flow coming in. I'm basically just going to sell the high duration ones right now. Yeah, I think that's my best bet. And just load up on low duration bonds that are very, very liquid. $34,000, 213 gain. Pretty exceptional. So right now we're at $246,000 in cash and $113,000 in corporate bonds that are kind of mid-range because it's been like 2029. So like this is a 10-year, this is 12, this is 1 year. This is a long duration one, but I'm thinking they got downgraded. So I might just keep that for some cash flow. How are they doing? Are they solvent? They're still triple B. Don't know why we didn't make that much of a return off it. Maybe because I bought almost at par. But anyways, I think that's going to call it for today's episode. We got to see on how the financial crisis resumed and became a pretty big deal, and we made a lot of money off of we made almost $80,000 off of the downturn. So we bought around 8% to 10 and we sold around here. I'm still gonna keep a lot of my bonds, so if interest rates continue to go down, I'm happy, but I'm equally as happy if rates continue to go up. So I may next episode decide to sell this bond. And then I may end up, I'm going to get paid almost 50K from this bond. So we're going to be in pretty decent condition tomorrow to, oh no, some other day. I'm probably not going to do it tomorrow. But I'll be in a good condition to continue to grow my wealth in this game. Hopefully I taught you guys a little bit more about like how to make investments and everything. Because I feel like this was a pretty good stream. Anyways, I'm going to head to bed, because it's like 10:19 right now where I'm at. So I'm gonna talk to you guys later. Have a good one. Bye bye.